Hello and welcome to CNBC TV18's Mumbai newsroom. I'm Sumaira Abdi and you're watching MF Corner. On the show today, we are going to be talking about the types of asset allocation and the principles of asset allocation. How do you go about it the right way? Harshvardhan Roongta, a certified financial planner at Roongta Securities, will join in to talk about exactly this. Harshvardhan, good afternoon. Thanks very much for joining in. So asset allocation is literally the foundation, right, of a person's financial plan. So if the foundation is strong, so is your plan. So first, let's start by talking about, what exactly should retail investors understand when they're told, have you done your asset allocation? And secondly, what are the types of asset allocation strategies?
Hi, very good afternoon, Sumera. It's always a pleasure to be on this show. You picked on a very important topic as to asset allocation and the importance of asset allocation in portfolio construction. So before we get into those details, let us just very briefly understand what is asset allocation because we've been talking about it, n number of times. So asset allocation is nothing but an exercise wherein an individual undertakes to determine how much of her investments would go into, say, equity, debt, precious metals, could be real estate as well. So it's just an exercise of splitting your investments into different asset classes. Now, and why do you do that? Because each underlying asset has different characteristics and they behave in a different manner as per given market conditions. Like, for example, when equity markets are very volatile, you will find gold to be a safe haven. So, if equity markets are going down, you will find gold to be, the gold price will either be stable or they'll go up because gold prices and the stock market are actually, negatively correlated. So that is why an investor will first get into that zone wherein they will say that I'm going to be splitting my money into different asset classes so that I have a good balance across different market conditions. So that's essentially what asset allocation is. Now, if you get into the types of asset allocation, so basically, what are the different ways you can define your asset allocation? Now, if asset allocation strategy is being developed based on three different fundamentals. So one is that you need to keep in mind your risk tolerance. You need to see how old you are, and then you need to see, what is your time horizon. So based on this, you will design your asset allocation. Now, different types that you can take. The first one being that you design make an asset allocation mix based on your age. So this is very simple. If a person is, say, probably a 30-year-old says that whatever my age is, I will invest that much into debt. So if you're a 30-year-old person, then 30% of your investments will go into debt and 70% of your investments will go into equity. So this is as simple as that. And as your age progresses, you keep making that, you make changes into that allocation. So that much amount will go into debt and the rest into equity. The other that we can talk about, the other method, that is your constant weight, or you call it strategic, you call it a static asset allocation, as you may call. So the second strategy would be that. Now, what this strategy essentially looks after, and in this case, you will take into consideration only your risk tolerance, and you take possibly your goal. Age would essentially not be a factor into this. Now, what you do in this strategy is again very, very simple. You take your equity and you take your debt. So you say that I will have 60% into equity and 40% to debt. Now, this would be basis, as I said, you will take your risk tolerance and you will take your goals. And you may not consider age into consideration. You may not take any other factor. You may just say that these are my parameters on which I will decide how much goes into equity and how much into debt. So if you determine that 60% into equity, 40% to debt, now, as and when the market goes up, suppose equity valuations, after 1 year, you see that equity valuation markets have gone up by 20%, for example, and debt has gone up by 5%. Now, your revised valuation at the end of the year would be 63% equity and 37% debt. Why? Because equities has gone up by 20% and debt by 5%. You rebalance this whole thing by selling equity and buying more of debt. So 63% needs to come down to 60% and 37% of debt allocation needs to go up to 40%. So this is more like a constant weight wherein you say that portfolio is designed as per certain metrics and then you rebalance it at the end of the year given the valuations that you're talking about. Another method that an individual can possibly undertake is a dynamic asset allocation. Now, in this dynamic asset allocation is another very interesting strategy wherein you don't design your, the asset allocation mix based on valuations. Nothing. You don't put in you don't put in your age as a consideration. You don't put your risk tolerance. You don't take into account your goals. What you do is you do the equity allocation based on the market valuation. So this has moved out of your personal domain to say that what is my risk tolerance, all that. You go to the market valuation. Now, equity valuation matrix can be different. It could be, you could have underlying matrix of valuation to be a price to earning, or you could be a price to book level. And then you decide based on market valuations, how much of my allocation will be in equity and debt. Now, in this, there are two different strategies that you can undertake. One is a counter-cyclical, one is a pro-cyclical. There are different ways in which you can, design your asset allocation mix based on this type, which is the dynamic asset allocation. Most popularly, if you we've been talking about the balance advantage fund, which is nothing but a dynamic asset allocation fund. So, a counter-cyclical, for that matter, would be that you buy low and sell high, and you can have some matrix assigned to it, just like how funds do it. In case you want to do it yourself, even the schemes do this. You have certain matrix saying that if the market index PE is say 21, you will have an equity valuation of equity allocation of 60%. And if the market PE goes up to 30, I will have an equity allocation of 40%. So you make these changes based on market underlying market valuation.
Talking
A
about
pro-cyclical would be the other way around, to say that if the markets are going up, I will participate more in equity. If it's coming down, I will reduce my equity allocation. So this essentially would be more of a dynamic asset allocation kind of a mix that a person can create. There is one more type of an asset allocation which probably is more applicable to market experts and those who can time the market. Now, in this would be nothing but a tactical asset allocation, wherein you begin your asset allocation plan with certain allocations, saying X amount in equity, Y amount in debt, and suddenly you feel that there is some kind of upside in the market, there's some momentum in the market, or there's some event which is going to play out, because of which you believe that the markets will either go up or they may go down on the other way. So what you do is you tweak that asset allocation originally that you started with. Say you started with 60/40. You tweak that a little bit to either increase your equity allocation or decrease your equity allocation, and this is only a temporary phenomena until that event plays out. So once that event plays out, then you come back to your asset allocation. So this is more of a timing the market kind of situation. So as I said, more applicable to people who can track the market, monitor and time the market, or who want to do that. So it's a temporary change in allocation to capture certain market moments and then come back to the original once that event plays out. So these are essentially the 3 to 4 types that individuals can look at and create their asset allocation plan.
Okay, so Harsh, you mentioned that tactical, of course, is for, say a very sophisticated investor or an expert in that case. But, there are still three other kinds of asset allocation strategies, right? So say if I, as an investor, how would I, or rather on what basis should I decide whether I go for the asset allocation strategy, which is based on, say, age, or should I go for one which is constant in its weightage? How do I decide which one suits me?
Well, Sumera, this is a very important question which needs to be answered in a very practical manner. So, see, what happens is, while you may have several types of models available, you need to see what is implementable by you. So, in simple words, what can you put into effect and monitor and track regularly? So, while I might say that there are different models, but are you in a position to individually do that yourself? So, as I earlier said, that tactical is more for people who can time the market, who are experts, who can know when the event is going to play out, etc. So clearly, it's not for the retail investor. A regular layman retail investor should stay away from this. In my experience, a constant weight is more, it's more of a model which is friendly to the retail investor because it's simple. I mean, you will put into consideration your risk tolerance. You will look into your goals and time horizon, and then you will fix an asset allocation. So you have a 60/40, whatever. So it's more easier to implement and to monitor and to put into effect. And one must remember there is no right and wrong. So if you're not doing a tactical, you're not doing anything wrong. If you're not going into dynamic asset allocation, so every model has its merits and demerits. You need to see what is more suitable to you and which you can implement effectively. So that will essentially be the method. My experience, a constant weight or a static or the strategic that I talked about, that is more practical for a retail layman investor.
The best of models won't work for you unless you can implement it correctly, and that really is the key. Do what you can do and do it well. So now, if the person has chosen, the strategy that suits them in terms of asset allocation, one is that within it, how would they allocate to different asset classes?
Oh yeah, so that's again the next step to this, a very logical next step. So assume that you've taken an asset allocation where you've started with a 60% debt. I'm sorry, 60% equity. So you say that I want to start with a 60% equity, 40% debt. Now within that 60% also there are different categories of equity. So you have a large cap, mid cap, small cap, etc. What you need to do is again go into your risk tolerance. You need to again then go ask yourself this question: do I want to allocate more towards small cap as vis-a-vis large and mid cap? Why? Because large caps will tend to be a little more stable as compared to mid caps and mid caps as compared to small caps. So in terms of volatility, the small caps will be more volatile. Mid caps will be a little lesser as compared to small cap, and large caps will be the least volatile. So there a person goes into that calculation again and that profiling again to say how much volatility do I want in my portfolio and then make those allocations. So therein again, you may say that I want a 50% of the 60% into large cap and the balance I could go into mid, small or thematic, sector, international, so whatever. So then that is how you will go about doing this based on your own risk tolerance.
All right, Harshvardhan, we're going to take a very quick break, but there's more to understand on asset allocation, and we will do all of that when we return. And primarily, we will focus on how do you know if your asset allocation strategy is working to its optimal capacity, and also how do you rebalance? Does it differ according to the strategy you've adopted? All of that is up next. Stay tuned. Hi, welcome back. Harshvardhan Roongta, Certified Financial Planner at Roongta Securities, is our guest today, and we've been talking about the types and principles of asset allocation. Now, Harsh, you have explained to us the various strategies which are there in terms of how you decide to do your asset allocation. But rebalancing is an equally important part, right? Now, if we ask experts that, how often should I rebalance? So some say 6 months, some say once a year, some say a tax filing season or, corresponding with market cycles. But my question is more fundamental. Does every type or style of asset allocation strategy have its own parameters in terms of how it must be rebalanced?
Yes, to a certain extent, yes. Each strategy will have certain, nuances attached to it, specifying as to how often should you rebalance. So if you just take the different styles and just put some basic parameters, of course these are not cast in stone. I mean, these could be guiding factors to decide how and when should you change your, rebalance your portfolio. So if I look at the age base, as I said, if you're a 30-year-old, you deploy 30% in debt and the rest in equity. You would not really do this every year. Like, you're not increasing to 31 if you're, once in a year. So what you do in an age case is you do it once in 5 years. So that would be a 30 becomes 35. So that allocation you will do as per your age and once in 5 years. If you look at a constant weight, ideally you should do it every year. Or in case if it's before 1 year, it should only be if there is a sharp movement in the market. So say about 30-40%, there is a market move suddenly that changes the allocation midway. Then you would obviously want to rebalance it. And if it's not that much, then ideally do it after once in a year. You look at dynamic asset allocation, again, the rebalancing would be once in a year, unless again there is some kind of an event, which is affecting the markets largely, which could be the subprime of the 2008, or you would say a lockdown or COVID-related lockdown when markets suddenly crash. So in that case, when the market valuations change, the underlying factor on which basis you develop your asset allocation mix, when that is changing, the valuations are changing, then of course you will want to change your asset allocation and rebalance it for a simple reason, so that you want to capture that valuation matrix that you are trying to undertake. Tactical is more to do with, the tactical is that you change your allocation temporarily because there was an event that was going to be happening in the market. Now, so when that event plays out, you would want to come back to your original plan. So this would be essentially when that event actually plays out. So these are the ways that you could become a guiding point as to when should you rebalance. And timing, I mean, I would not really suggest you should rebalance based on tax season or any other such thing. It's more to do with your time horizon, goals, and risk tolerance. So keep in mind those factors. If there's anything changing there, then you change.
Okay, but Harsh, how would we even know that the asset allocation we have adopted to our portfolio is working at its optimal capacity, or if there is scope to improve it?
So Sumera, the reason why you do investing and why do you make an asset allocation mix is that on a portfolio level, you want to beat inflation. There are a few things that you want to achieve, right? When you make investing, when you invest your money. So the first one being, of course, that irrespective of what the market conditions are, I'm investing to different asset classes and they're behaving differently in different situations. So what is my ultimate objective? That one, I should get peace of mind. I should sleep peacefully. It should not really, disrupt my sleep. I should not wake up in the middle of the night and say markets have crashed, and my portfolio is going to go completely, go to zero or something like that. The second most important is that you need to beat inflation. I mean, on a portfolio level, not on an asset level. So you're not saying equity beating inflation, debt not beating inflation. Looking at a combined equity debt allocation and saying that my overall portfolio should beat inflation sufficiently. And the third point is that I should have liquidity when I require it. So if there is a goal that you're achieving, if there is some requirement in between, you planned adequately and you have assets from which you can withdraw and have liquidity to your side. So in case you have achieved these three parameters out of your investing, then I think you have got an optimal asset allocation strategy. And if any is missing, so suppose you've got something wrong in the entire equation of allocation, you will either be very worried if the markets fall, either you will not get money when you require it, and you will not be able to beat inflation. So if you're meeting these three criteria, you should be happy that you're doing a good job with your investment.
Okay. So, Harsh, earlier you had explained that within this asset allocation, say the, 100 minus your age would be your equity allocation, right? And debt and gold would be what is your current age. So, that is how, suppose somebody has divided their portfolio. But if you have like pure equity funds and pure debt funds, you're fine because you have done your allocation. Now you introduce something like a hybrid fund into the mix, and over here you are not the one who's controlling the allocation within that hybrid fund, right? Your fund manager is. So does the addition of a hybrid fund to somebody's portfolio, which also has pure equity, pure debt, gold, and whatnot, disturb the balance in terms of how you're doing it? Or does it not matter if your allocation is small?
One is if your allocation is small, it doesn't really matter. But in any case, what you're saying is right because we talk about allocations between equity and debt. We talk about rebalancing it. However, if you've invested into a hybrid fund, you do not have that leverage because you don't control the equity allocation because you'll have schemes which have allocation with a minimum of say 10% going up to 80% into equity. So this allocation is not under your control. The fund houses will give you different schemes. I mean, they will have different types of hybrid funds, one being a conservative hybrid fund. Now, what a conservative hybrid fund does is it allocates a maximum of 25% in the equity. So again, how much is the, whether it's 10% or 25%, that will depend on the fund manager. So you don't really have a control on that. Now, if you look at an aggressive hybrid fund, they will have an allocation between 65% minimum going up to say probably 80%. So again, you don't have control over there. Now, if you talk about dynamic asset allocation funds, the allocation could be as low as 40% going up to 80%. So very clearly, your question is very valid that in case you have also a hybrid fund and equity and debt on your own, then you cannot have this combination and actually rebalance and control how much goes into debt or equity. In fact, hybrid funds could be used as an asset allocation fund. So those people who do not want to actively rebalance, allocate, etc., can define what they want. If they think that they want a 60-40 kind of a ratio, so they can go for an aggressive hybrid fund, which has a minimum 65% allocation into equity, and that's how you will have. But that could even go up, so that could go to 80%. So dynamic asset allocation funds come into that picture, which take the market valuation as a metric. So yes, you're right. And if a person has a hybrid allocation plus an equity debt, the asset allocation plan will not work, and then mix could change based on the allocation of equity in the hybrid fund.
Okay, and this is when you have only one hybrid fund, Harsh. There are people who have multiple hybrid funds, so that'll, I'm sure, just confuse you to smithereens. But we take your point that if you're looking at a substantial allocation to hybrid funds, then you have to see how it sits with your overall portfolio. Harshvardhan, thank you very much for joining in. And of course, I would have loved to ask about how to change this asset allocation strategy with age, change in lifestyle, and of course, goals. But maybe we'll save that for a later day. But that is also something that you, our viewers, should keep in mind, that with your change in your age, lifestyle, and the goals that you have, you must keep updating your plan as well. With that, we'll wind up on MF Corner. Thank you very much for watching. Do stay tuned in. The team of Closing Bell joins you next.